Hi everyone! Welcome to your class of Financial PR lecture number 4. So today we're going to be covering lecture 4 on the stock market. So basically what is going to happen is this. Today what I will do is I will be giving you a mini lecture on what is the stock market and what is the basic of the stock market. After which I will give you a Padlet link. Now, what you need to do is to record a video of yourself, basically giving me feedback on this particular class of the stock market. For example, what are the things that you do not understand about the class and what you think is challenging about the stock market, right? So you can do that. And I will also be posting some of the questions along the way as I talk. So make sure you pay attention to my lecture to know what are the questions that I pose so that you will be able to upload a video of yourself answering my questions onto the Padlet link that I will give you later. Um, After this as well, I will be giving a revision where we will be having an online game. All right, so we will be doing an online game in order to recapture what you have learned in this class. Now, as you can see, I got a very nice background here today. I figured something outdoor might interest you guys. So what are we going to do today is we're going to talk about the stock listing, merger, and acquisition today. Now, what is going to happen is that let's talk a little bit about why do people do business, right? Now, nobody that is called business for a reason, and obviously, everyone who does business, they are doing it for the sake of getting profit, right? Now, so when you make money in business, it is called profit. So mathematically, I know most of you do not like mathematics, but mathematically, what is profit? Now, profit is equals to your revenue minus your costing, right? So whatever money that you gain minus the costing, that is what you call profit. Now, obviously, if let's say the money that you earn is not enough to cover the costing, that is what we know as losses in business. Now, so the toughest part in business is always to begin a business, right? Now, so how do you raise money to start a new business? Obviously, one of the most conventional way is to borrow money from the bank. So this money must be paid back, right? Now, the second way that people always go to is that you can sell the ownership of your company. Now, that means you have other people who give you the money and they have a share in the profit as well as the losses of the company. Now, these owner shares are what you call the shares of stock. That's how stock begins, right? Now, uh, if let's say you earn well in your business, right? So these people who actually have a certain partnership or ownership of your company, they will get dividend from your profit, right? So profit equals to dividend in the case of the shareholders. Now, how does the stock market works, right? Now, imagine yourself going to a night market. You go to night market, there's so many vendors selling curry puff on one stall, and you probably get watermelon on another stall, and you probably get sugarcane water on another stall, right? Now, that's how the night market works. Now, it's more or less the same thing that you can imagine when it comes to the stock market. Why do I say that? In the stock market is where people buy and sell shares of company. So if you own shares of a company that is public listed, you can sell them to other people in the stock market. Now, what are some of the famous stock market available in the market are like New York Stock Exchange, Nasdaq from US, and even Japan Exchange Group is one of the most famous one in Asia. Shanghai is good as well. Hong Kong Stock Exchange is good as well. Now, in European country, usually they trade in the Euronext as well as the London Stock Exchange. Okay. Now, moving on to the next slide. So, what happened to your stock prices is that when a company is doing well, more people will definitely want to buy your stock because you are doing well, right? And therefore, your prices in the market will rise because there's so much demand for your stock. However, if your company is not doing well, more people will want to sell your stock. want to sell and nobody buys, so therefore the prices will drop. So basically, stock market works on a demand and supply basis. Now, there are two different types of share. One is what you call the common share, and another one is what you call the preferred share. Now, the terms equities usually refer to common share. All right. Now, as you can read, the common share combined market value and trading volume are many magnitudes larger than that of preferred stock, preferred share. So, in another word, most people what you have in hand is the common share. Now, the common share differences with the preferred share is that the common share carries voting rights. That means you get to decide and have a say in the AGM or who are the people in the board of directors. So you get to vote for that. Whereas people who buy preferred share, they don't get the voting rights. But having said that, preferred share are known as preferred share in a company because they actually get higher dividends and also the asset in the event of liquidation. Now, why is it like that? You see, if imagine if you're a boss of a company, and you do want people to invest into your company, but obviously end of the day you will want to have most of the share, most of the say in the company, right? So therefore, a lot of owners they do like when people buy preferred share because okay, you're investing money, but you don't really have the voting rights, right? So preferred share is usually preferred because it brings higher value. But if let's say you want to have say in the company, you go for common share. So there's pros and cons of both. Now, um, there's a lot of things that you need to understand about the fluctuation of share prices. Okay, you can read from here. Again, I will upload all of these slides as well into your times, and also as you go into your Padlet, if you do find that it's difficult to understand how share price fluctuates, do let me know. All right. Now, so the overall market is made up of millions of investor and trader, right? So in the market, in the stock market, there's a lot of investors and traders who wants to invest into different companies, right? Now, there's a lot of transaction that's going on. And in this market, stock market, you do have what you call the stockbroker. Now, the stockbroker is the middleman between the buyer and the seller. Now, let me point to you, right? So, the middleman between the buyer and the seller. So, what do we mean by the middleman of the buyer and the seller? So, if let's say you are inexperienced when it comes to share, well, basically what you can do is you go through a stockbroker. They will advise you on what is the best share to buy and so on and so forth, right? Now, again, remember the concept of supply and demand that I told you earlier, right? Now, supply and demand, it works in real time when you're talking about the stock market. So it changes every second, every minute, which is why if you look at real stockbroker, you will notice that they do love being in front of their computers all the time, right? So now there is this term called the bid ask or the bid offer spread. Okay. Now, what does it mean by this? Okay. Now, so basically, somebody will offer to buy. Okay, somebody will want to buy it, and then basically, the people with the share, you get to bid. So you bid, and obviously, the person who asked, they will want to get it at the lowest price, whereas the person who is selling, they will want to get the highest price possible. So there will always be this transaction and negotiation that is going on. Okay, and of course you have to come to an agreed price end of the day, right? So a trade transaction occurs when a buyer accept the ask price or the seller takes the bid price. Now, if the buyer outnumber the seller, they may be willing to raise their bid. So basically, if there's a lot of people who wants to buy the same share, obviously the share price will go up because the seller will have said, "Oh, I do not want to release it at such a low price because other people are willing to pay for more than this, right?" So that's how it goes. So basically, it's just like you going to a night market and trying to bargain the price with the vendor, right? Now, in understanding the stock market, right? Sometimes what you have to go through is you have to understand the company's earning guidance. So, what is an earning guidance? Earning guidance is also known as guidance or forward-looking statement. In another word, is prediction. So what happened is that every public listed company, they will have information that they will disseminate to their shareholder to indicate the projected future performance. That means, oh, for the next quarter, this is what we are planning to do. We will be doing very well next quarter because we will be earning through this project or that project, that sort of stuff, right? So what are some of the informations that they do have are like revenue estimates, projected earning, and capital spending estimates as well. And this is usually released quarterly. And this earning guidance is very important, especially for analysts, because they will want to decide on the spend. Sorry about the low battery. Now, so the purpose of it, end of the day, is to convince the investor, right? And guidance statement carries the potential risk of being incorrect. Now, for this reason, safe harbor provision were instituted to protect companies from being sued should their forward-looking expectation fail to bear out. Now, in another word, they will try to predict, oh, this upcoming time we will be earning this much. However, sometimes, due to circumstances, they may not be able to fulfill that expectation. So therefore, when the expectation is not being fulfilled, they they are protected by the law basically. So you can't sue them, but of course they can't be overly ambitious in their earning guidance as well, because then it will make the investor more skeptical on investing into their companies, right? Now, so what I want you guys to do right now, after I gave the short introduction to what the stock market is like, I want you guys to go to this particular link, right? I want you guys to go to the link over here. Yep. I want you guys to go to this link over here, all right? www.investopedia, all right, to get the term and understand what the IPO, initial public offering, is all about. So I want you guys to watch the video. And here's the catch. Therefore, in the video that you upload on your Padlet, what you need to do is to discuss and to tell me what you think exactly is IPO and what you think is interesting about this video on IPO. So I hope that you will enjoy this video. So that's a quick lecture that I've given, and I hope you guys enjoyed it. I will be uploading this and into your times, and I will be looking forward to your comments on Padlet. And do watch out for the upcoming quiz for you to refresh your memory a little bit as well online. Now, take care, guys. I will see you guys around. So do enjoy your day, and I hope to see you in the next lecture. So goodbye.